The short-term effects of severe or acute demand-supply imbalances are that prices are going to get out of whack. So that's exactly what we're seeing. We're seeing a lot of capital coming into Singapore as a result, I think, of our successful reopening of the economy post-COVID. And as a result, I think many global investors see Singapore as a preferred investment destination. And that's one reason why we've had so many family offices get set up here. A lot of institutional capital is looking for a home in Singapore. And when that happens, you get offices being set up, you get people being deployed into Singapore, you get capital looking for a home, looking for investments. And that just sort of adds to the demand situation for the Singapore economy, for Singapore real estate. So I think it will take some time to level out. We don't want to see it overheat, which is why you're seeing some of these policy responses coming in to tame an engine that is showing signs of overheating with sort of runaway inflation, let's call it that. So I think this is it's a good policy response to try and take the economy down, cool the global economic engine down to a point where we can sort of continue to have sustainable growth. And I think that's a good thing for the overall economy and for CapitaLand.
Lastly, Andrew, we are seeing rising interest rates really starting to feed into Singapore, including in the mortgage rates here as well. Generally, it's been seen that interest rates have been seen as a bit of an adverse or negative reaction or impact, at least, for real estate investment trusts, which CapitaLand happens to be one of the, if not the biggest managers of here in Singapore. If rates continue to rise, do you see this as posing potential challenges to CapitaLand and perhaps your acquisition plans in the years ahead? Will you be less? Will the appetite for acquisitions from CapitaLand Investments be a little tempered by the fact that we've seen rates higher than we've seen at their highest levels than in years?
Yeah, it's a very good question. I think going forward, it's going to be very interesting how this plays out. As I mentioned in the previous answer, the policy response to high inflation is to sort of tap on the brakes and by raising rates. So that's, I think, a good thing. You want to cool this engine down. It's also helpful to remember that we've come from a decade of historically low rates. So one way to look at it is that it's not high rates, it's more normalization of rates from a very, very low period of hyper low rates. So I think it's just going to take some time for all of us in the investment and in the real estate community sort of work through the numbers and see how this plays out. Once we see evidence of the economy stabilizing and the pace of rate rises sort of tapering off, then we can sort of start to recalibrate to see how this flows through to our investment decisions. And I think that will sort of begin that cycle again of reinvestment and capital recycling. In the meantime, I would imagine that most practitioners are going to take a cautious tone because we don't know how far this thing goes. So the short term, yes, I think we see some hesitation. But in the long term, what you do want to see is this comfortable soft landing onto where rates land and where inflation is tamed. And then that allows us to get going again on capital recycling and investment. In the meantime, it's important to keep your balance sheets strong and to be able to take advantage of opportunities that will come, because we all know that when things are uncertain and you've got players of different strengths, different balance sheet signs of robustness and weakness, then that's a good time for us to be in the markets looking for investment opportunities.